All right, today we are digging into a really powerful and honestly kind of counterintuitive investing rule from an absolute legend, Peter Lynch. And I'm telling you, his advice might just completely change how you look at the stock market.
So let me ask you a quick question. When you're looking for a stock to buy, do you ever check to see what the big Wall Street funds are buying? It seems like a no-brainer, right? Just follow the pros. But what if I told you that could be one of the biggest mistakes you can make?
To get why, first you got to understand the modern market. It's a landscape totally dominated by giant institutions. We're talking mutual funds, pension funds, insurance companies. They are the herd, and they move trillions of dollars around. Now here's where it gets really interesting. The massive difference between you, the individual, and them. You have these incredible advantages. You can be patient. You can think for the long term. You can be flexible. Institutions? No way. They live and die by quarterly performance reviews, they tend to all move together, and, this is critical, they can be forced to sell for reasons that have absolutely nothing to do with how well a company is doing.
You know, the common wisdom, the advice you hear pretty much everywhere, is super simple. See where the big money is going and just follow it. It feels safe, right? It feels like the smart, validated play. But Peter Lynch, the guy who took the Magellan Fund from $18 million to $14 billion, yeah, with a B, he had a completely different take. He issued a really stark warning against blindly following this so-called smart money.
And that brings us to Lynch's simple but totally game-changing rule about where the real money is actually made in the market. And there it is. That's Lynch's entire philosophy in one sentence. The truly massive, life-changing returns, what he famously called multibaggers, they're found in the undiscovered gems, before the herd even knows they exist.
So why was he so adamant about this? Why was he so against the popular stocks? Let's break down the specific dangers of investing in a stock that's become a Wall Street darling.
Okay, danger number one, and this is the most straightforward one. You're simply too late to the party. The train has already left the station.
I mean, think about it. If institutions already own most of a company's stock, that means it's been thoroughly discovered. The big wave of buying that pushes the price up, that's already happened. Future demand is limited. The good news, the amazing growth story, it's all already baked into that high stock price. The potential for that explosive growth is just gone.
The second danger is even scarier. It's all about risk. When you buy a stock that's super crowded with institutions, you are buying into some serious and often totally irrational volatility.
Lynch absolutely nailed it here. It's just a simple law of supply and demand. If everyone who could possibly buy the stock already owns it, who's left to buy when things get a little shaky? Well, nobody. That leaves only one direction for the price to go: down. And when that herd decides to sell, they all try to get out the door at the same time.
So what's the tipping point? Lynch often pointed to a level around 70 to 80% institutional ownership. When a stock gets this crowded, it basically becomes a powder keg, just waiting for a match.
And here's how that explosion happens. It starts with some kind of trigger, a bad earnings quarter, a scare in the broader market. That causes investors to start pulling money out of the funds. The funds then have their own internal risk rules kick in, and they are forced to sell their holdings to raise cash, whether they want to or not. It doesn't matter how good the company is long term. The result? A massive, irrational price crash.
And the final danger, honestly, this might be the most important one for you as an individual investor. By chasing these popular stocks, you willingly give up your single greatest advantage over the pros.
See, here's the crucial difference. Fund managers are judged every single quarter. They have a boss to answer to. They can't afford to look wrong, even for a few months. But you can. You don't have that pressure. You have the gift of patience. When you buy what they buy, you're choosing to play their short-term game, and that's a game you're just not built to win.
So if we're not supposed to follow the herd, what's the alternative? Well, this is where Lynch's genius really shines. He was a master at hunting for what he called wallflowers, the stocks that nobody else was paying attention to at the dance. I just love this quote because it gets right to the heart of his strategy. He would actively look for companies with boring names and dull industries, or ones that just sounded a little bit ridiculous. Why? Because he knew that's where Wall Street wasn't looking. And where Wall Street isn't looking, that's where you have the best chance to find a wonderful business at a bargain price. And here's basically his checklist for finding those wallflowers. He wanted companies with very few Wall Street analysts covering them, and of course, low institutional ownership. He loved simple businesses you could easily explain, that had strong earnings and very little debt. He was looking for great neglected companies whose business was just starting to get better before the herd even had a clue.
Okay, so let's bring all this home. The core lesson from Peter Lynch isn't just about avoiding a certain type of stock. It's about reclaiming your unique and incredibly powerful edge as an individual investor.
This really sums up the whole logic, right? High institutional ownership means the stock's already been discovered, and there's not much buying power left to push it higher. That crowded ownership creates a massive risk of a stampede for the exits, and by following them, you're throwing away your biggest advantages, your patience and your ability to be different.
And that, right there, is the single most important takeaway. Your ability to be patient, to ignore all the short-term noise, and to look where others aren't. That is your superpower in the market. Don't ever give it away by trying to be a bad imitation of a Wall Street fund.
So I'll just leave you with this question. Go take an honest look at your own portfolio. Look at the stocks you own. Are they the darlings of Wall Street, the ones owned by every major fund? Or have you found some overlooked, unloved wallflowers that have amazing potential? The answer could really make all the difference.